everybody. I'm Mukaya Panich, CIO of SCB10X. And today I'm very excited to have Rune Christensen, the founder of MakerDAO and CEO of Maker Foundation with us today. I'm actually very excited because I'm a very big fan of you, Rune. And this is my first time talking to you too. So thank you so much for joining us today. Let me introduce a little bit. MakerDAO is, I think, actually the oldest DeFi project. And Rune is pretty much the original gangster of crypto and DeFi space. MakerDAO has DAI stablecoin, and we are very excited to see that at the end of November, we see DAI market cap has gone past above $1 billion, which is very impressive growth because at the beginning of the year, it was around $100 million. And yeah, as of today, MakerDAO is #1 in total value lock on DeFi Pulse. So have to say that Rune, you are reigning supreme right now in DeFi. So
thanks so much for having me.
Yeah, so can we start off by asking you to introduce yourself and talk about MakerDAO a bit, and why did you start it? And so far, how has it evolved, and what is your vision and goal for MakerDAO?
Certainly. I mean, personally, I got into crypto all the way back in 2011 when I first bought Bitcoin and got into the whole crypto scene there. And then basically, I started out as like a big time Bitcoin maximalist, because I think a lot of people, when they first see this technology and sort of, like a lot of people talk about the moment where they understand the potential of blockchain technology, and you just have this like extreme excitement about how this is going to change the world. And in the very early days, it was, everyone was convinced that Bitcoin was it, and Bitcoin by itself basically bring about all of this transformation. But I mean, basically after having been into Bitcoin for like 3-4 years or something, I started, first of all, it's like there was a couple of bubbles, right? Like, so a lot of people went through this experience of earning a lot of money on Bitcoin and then losing a lot of money on Bitcoin, basically. And through that, there was essentially this like movement of people that started realizing that you could go further than just having a simple cryptocurrency, but you could actually create more advanced applications with blockchain technology. And really the very first of these ideas was, like at least one of the really early ideas was the stablecoin, right? So the idea that you could actually create something like a derivative, right? Where you use one asset to basically create another synthetic asset. And Maker itself was created out of this idea through actually the BitShares community. So BitShares was this like super early crypto project that did a lot of really cool things very early on, but just didn't really get traction. And then me and a number of other people from the BitShares community, we basically took the concept of the stablecoin and decided to implement that on the Ethereum blockchain when we saw, Ethereum basically come into the limelight around 2015. And I mean, and the basic idea is that there's so much potential with blockchain technology, but if you want to really get real world adoption, right? If you want to use that potential to transform the real world, you have to remove all the downsides. And pretty much the #1 downside with Bitcoin is the volatility. And it's pretty straightforward. And I think it's really the experience of going through bubbles and basically that actually living through that extreme volatility really teaches you that regular people and real world businesses, they need, they can't accept that kind of downside because it just, it makes their business models and sort of their day-to-day life completely, it has too big of an impact. So that's why you need to create stable cryptocurrency in order to basically eliminate this downside and then open up for the potential of blockchain in terms of efficiency, decentralization, interconnectedness between, different actors in a more permissionless manner, and really all of these cool things that pretty much are really, nowadays have started to really materialize, right? But and it's quite interesting also to see how what we really set out to do back then in 2015, which was to try to create essentially the foundation for an ecosystem where everything could work together in synergy, and people could seamlessly collaborate. That ended up essentially emerging in the form of DeFi, and we now see that in real life. And I think it's kind of mind-blowing to me to actually see that for real, when it's something that we sort of were dreaming about back many years ago.
All right, yeah. So let's talk about stablecoin a bit. Right now, there are several different types of stablecoin. There are fiat-backed one like USDC, USDT, and there are crypto-backed one like DAI. And increasingly, we also have CBDC, central bank digital currency, that are coming out. How do you see the ecosystem of stablecoin evolving in the near future?
I think it's really interesting that you can really think of like the history of stablecoins as being essentially there's basically, I mean, it actually is, there's Tether on one hand, there's this traditional straightforward model of you take some money in the bank and then you represent it with a token on chain, and then you basically promise to redeem it one-to-one. And the other perspective is basically the bit shares, sort of the early decentralized stablecoin perspective, that you have this token, and then you basically use that as collateral to create a synthetic asset that can then be settled in this other token. And the thing is that, I mean, there's basically like if you look at these two prototype ways of doing stablecoins, there's downsides with each of them, right? Because with a centralized stablecoin, I mean, the problem is that you're getting some advantages of the blockchain, you're getting some advantages of decentralization even, but you also there's also others you're not really getting, right? Because it is still centralized, and fundamentally, when you're building on top of a centralized stablecoin, you're actually building on top of a bank ultimately, right? So you everything rests on essentially like the traditional bank and the traditional financial system. With a decentralized stablecoin, the problem is that there's just, there's a lot of risk, basically. There's a lot of issues that really need to be dealt with. The biggest one in a sort of simple model is the black swan event, right? So the issue that if you don't really manage the risk very carefully in a decentralized stablecoin, it can actually get completely wiped out. Like all the money can just disappear, and that's basically an unacceptable risk, right? That this is not gonna be attractive to regular people. And in fact, it's like, in my opinion, as someone that's actually that's building a stablecoin and really trying to get adoption in the real world, it's even irresponsible, right? Because you could have a situation where people could just put their livelihood into some fancy technology, and then get completely financially ruined because of it if it's not designed correctly. So where Maker comes in is that Maker is really trying to combine these two sort of original approaches, right? Like backing it with a bank account, and then creating something that's just like an on-chain derivative. And the solution with Maker is to use multiple types of collateral. So basically saying we're not going to pick one single model. We're going to basically create a decentralized framework or decentralized platform protocol that is then able to back the stability of the currency in many different ways. So for instance, if you look at DAI today, it is actually both backed on one hand with a bunch with centralized stablecoins. So like USDC, and actually all of them, right? USDC, Paxos, TrueUSD, Tether, there's even a small amount of Tether in there, and GUSD, and just all of these different centralized stablecoins. So that basically represents that DAI is partially backed by US dollars in a bank account, just in the same way as any other centralized stablecoin. But then on the other hand, there's a huge amount of Ethereum and a huge amount of Bitcoin and a lot of other assets like that in the backing the DAI stablecoin as well. And this is really where, and that represents sort of the original decentralized approach, right? That you use something like ETH or Bitcoin or just a native token on a blockchain to back a stablecoin. And And the thing that's so interesting about that is that these two types of assets, they're just so different essentially that they're really like the opposite of each other in terms of their risk. Like centralized assets, like centralized stablecoins and USD in a bank account, that represents kind of like counterparty and regulatory risk essentially, right? That there's a risk that it can be shut down or seized or something like that. But on the other hand, there's not really any risk that it's going to crash in value because it's dollars and they're regulated, right? And they're in a real bank account, and there's FDIC insurance and all of these like really established things that just make sure that from the sort of financial perspective, there's essentially no risk. And then on the other hand, with the Ethereum tokens and the Bitcoin tokens, there's very little. I mean, with Ethereum, there's actually zero sort of counterparty risk, right? It's entirely 100% decentralized. But the downside there is that there is a volatility risk, and it can actually crash very rapidly because it's crypto. But basically, the point is that you really rather want to have sort of a combination of these two types of risks rather than just have all your eggs in one basket, because ultimately what it means is that you reduce the likelihood that people who use the system like in any possible outcome could just lose all their money out of nowhere, right? Because that again is like the risk that is unacceptable and also even like irresponsible to introduce that risk to people if you really want to build it on a large scale.
Can you talk a bit about the process of adding and approving the new asset as collateral for DAI borrowing? How does it work?
Yeah, absolutely. And it's so Maker it's a very advanced protocol, and yeah, like you said, also it's basically the first DeFi protocol. But even to this day, it's like one of the most advanced with a lot of different moving parts. And there's basically on one hand, there's the stablecoin. So there's the DAI stablecoin, which is pegged to $1 and that's used by as money by businesses and crypto traders, and even by a lot of regular people in South America. They just use it as their sort of day-to-day cash. But that's just one type of user and one part of the system. And so the other sort of part of the system is the collateralized lending market. So this is actually essentially a peer-to-peer like credit market, essentially, where people, what they can do is they can post collateral into the system, so like stable coins or ETH or Bitcoin, and then borrow DAI against that in the same way that you actually go to the bank and get a mortgage against your house, for instance. So you can pledge your house as collateral and then you can get money from the bank. And with Maker, it's that you add these like crypto assets like Ethereum, and then you can instantly borrow DAI. And there's some really cool advantages to this because it's on-chain, so it's like absolutely instant, right? So you can literally do a $10 million loan from Maker in a second, in an instant, and you can even like borrow 10 million DAI from Maker, and then pay it back 30 seconds later, and only pay basically a cost of credit for those 30 seconds. Which I think is really cool, right? Really, and this is really the thing with DeFi, that it's so incredibly sort of lightning fast. And so the question is, how do you like add another asset into this protocol, right? Into this framework where you as soon as it's in there, anyone can just go and instantly use it as collateral to borrow any amount of money and use all of this flexibility. And so the answer is that there is a third piece of the system, which is Maker governance. And the purpose of Maker governance is essentially to sort of regulate and balance these two other pieces against each other, essentially. So on one hand, it's all about keeping DAI stable and ensuring that DAI remains trading at $1. But then also ensuring that there is like good sort of balance in the sort of long-term risk of the collateral. So for instance, making sure that there are some stable coins, some centralized assets, but also different types of decentralized assets. And over time, there should just be more and more variation and sort of more and more diversification of the risk. And so ultimately, the way it works is that the MKR holders, they actually just vote on chain to decide what goes into the system as collateral, and what are the terms essentially. So what is the rate, the stability fee essentially, which is similar to an interest rate, and what is the debt ceilings, like the total amount of debt that can be borrowed, and basically a number of other risk parameters like this that really like determine how much, like how good are the terms basically when you use this asset as collateral, and ultimately how much risk does it represent for the Maker protocol. And the sort of the key to the system makes it all work is that MKR holders, so basically the people who control Maker governance and who vote, and so they use this token called MKR, which is the governance token of the system. And the point is that, so on one hand, they vote to control what collateral goes into the system, what are the parameters, how much does it cost to borrow with it, but also they essentially take on the risk if they make a wrong decision. So if they accidentally, essentially, or like by misjudging the risk of an asset, if they add an asset into the system, and there is some sort of loss to the system because of that asset becomes worthless overnight or something like that, then if you have a loss in the collateral in the system, then if you sort of don't do anything, then that actually means that DAI becomes under collateral, like insolvent essentially, that there's not enough collateral in the system backing the amount of DAI that's outstanding, which again is a very bad thing, right? You want to have a stable coin, you want to have a world currency that is extremely solid, right? Extremely resilient. So the solution to this is that to basically make sure that the MKR holders, the Maker governance, they essentially take the loss if there is some sort of loss in the system as sort of the first line of defense. So the system actually will automatically generate and print new MKR tokens and sell it on the market in order to recapitalize any sort of loss in the system. And in fact, this has actually happened already in the March, the big crash of crypto in March. There was a huge loss. In relative terms, it was actually pretty small in terms of the overall size of the system, but it was several $1 million, and that was sort of the first like real like test run of this actually working in the system automatically, autonomously, just like recapitalizing itself and ensuring that as a DAI holder, there was no negative effects from that kind of extreme event. And that is just so important because it really means that now you have skin in the game as the people that control the system, right? So you have an alignment of incentives that potentially can overcome the principal agent problem, right? So the sort of the classical issue that in finance, if you look at the great financial crisis or something like that, the people who run the economy, they don't necessarily really, see much of any, like really, there's not many negative consequences for them when they happen to crash the whole thing, right? Through, reckless gambling on CDOs or something like that. And it's kind of like a rigged system, right? It's sort of this general feeling about traditional finance. And it's because it's totally opaque, right? Nobody knows who's actually running the show. Nobody knows what's actually happening. So people can completely, basically, escape the responsibility. And that's what is so amazing about DeFi, is that we can engineer a system that is exactly the opposite, right? It's completely transparent, and there's just this like direct recourse, essentially, like a direct line of responsibility and accountability with the people, in this case, the MKR holders, that make the decisions. And then, of course, finally, they also, like, they don't just take the risk, they also get some sort of reward when things go well. So all in all, the whole system is balanced out in that sense, and everyone's incentives are aligned in just like driving a protocol that can create a stable cryptocurrency.
Yeah, so Rune, you talk a lot about wanting to have real asset as collateral for DAI. When are we going to see that?
Yeah, so that, I've spent the last 2 years, maybe even 3 years, essentially just talking about DeFi needs real assets, and that's the next step. And that's what I completely believe, that that's the point where DeFi has been at for a while, even. That the technology is there now, like the basic sort of DeFi primitives exist, right? There's a lot of great protocols, and they can be combined together in a lot of really interesting ways. But the thing that's still lacking is like a proper connection between DeFi and the real world and sort of the real economy.
Yep.
And that's what's necessary in order for, first of all, for DeFi to properly scale, but also in order for it to actually provide real, real value to real people and sort of make an actual difference, not just dealing with speculation and dealing with sort of a smaller niche as it does right now. And it basically comes back, the way to also really think of it from the perspective of Maker is it comes back to the whole concept of diversifying risk, right? That right now Maker has a lot of centralized stablecoins. And to some extent you could say they actually are real world assets, right? It's like real dollars in the real world, but it's not it's maybe the least interesting version of real world assets because it for instance, like all of the kind of like the interesting economic activity is like I said earlier, right? It's almost like hidden away in the bank that's sitting underneath the centralized stablecoin. And when we talk about real world assets in DeFi, from the perspective of Maker, what we're talking about is essentially trying to do some of the same things that banks and financial institutions do, but doing more of it using blockchain and DeFi, and essentially like trying to open up a lot of these traditional business models and a lot of these traditional credit transactions in order to make them way more efficient and way more inclusive. And so the Maker community is one of the communities that's really at the forefront of this and have really intensively been spending the last 6 months or so, like trying to basically onboard the very first real world assets into the Maker protocol. And so right now there's actually the very first example of the Maker governance process, which I talked about earlier, right? Like this process of like choosing what to onboard, analyzing the risk, and then assigning risk parameters. That process is almost done playing out with one of the very first proposals to create this kind of like real world asset line of credit to like a traditional financial company. And so this specific example of what that the Maker community is actually right now, it's sort of running through the governance process in the Maker community right now. So it's being like discussed and voted on, and then possibly actually on Friday or like basically very soon there will be one of like some of these like bigger votes that will start like onboarding things onto the protocol on chain. And what it will result in is a line of credit that goes to financing a number of construction projects in New England. So basically commercial real estate development for something like some auto parts shops and like auto repair stores and that kind of stuff, which I think is really, it's kind of amusing to me to like see what this actually looks like concretely, that, oh yeah, this means that you fund the construction of like an auto repair store, which just seems so like sort of like such a regular thing or something like that, right? When for years we've been thinking about this in this very abstract term of like real world assets, we need to do this thing, and then the way it manifests itself is basically financing the construction of some buildings and that kind of stuff. That's really what it means, right? And the thing that's so amazing about this is that what this represents is these potential customers of Maker essentially being able to access credit more cheaply and hopefully in the future very efficiently, very smoothly, be able to like onboard into a process like this, get access to cheap credit, and essentially not having to go through a whole load of intermediaries they would otherwise have to go through, that would just that just sort of exist as financial intermediaries, so they can take a cut essentially. And I think that's really exciting, right? It's connecting small businesses much more closely with sort of like the core of the financial markets, right? Because it really represents being able to, it's sort of the equivalent of being able to borrow money directly from the central bank, for instance, right? Because really what's happening is that like these construction projects, they essentially pledge the sort of the legal ownership, the legal claim on all of the assets of the construction project as collateral into Maker. And then once that's sitting there as collateral in Maker, they're able to just generate DAI by, through the power of that collateral. So it really is like anyone can have the ability to be a central bank and create their own money, as long as they make sure that when that it's sound, right, that it's backed by something that has real value.
Mm-hmm. Oh, that's fascinating. Yeah, I can't wait to actually see that. Wow, I feel that I can actually like go on for another like 1 hour with you, because like there's so much to ask, but we have so few minutes left. But it's so good to actually talking to you. I wanted to ask about the use case of DAI. In the blog post of MakerDAO, you guys talk about 5 use cases. So as an inflation protection, like you mentioned, in Argentina, for example, people use DAI because of such hyperinflation there. Then there are also the use of like DAI in e-commerce, in gaming, in digital art, things like that. But the use case that take off the most is to gain access to DeFi. So I'm just curious, like in the future, what are other real use cases that you think will see strong adoption of DAI?
Well, that's a good question, because it's actually been in the past, it's not been very easy for us to predict where DAI will sort of take off next, right? It just sort of happens by itself. And that's, of course, that's the nature of decentralized projects, that the Maker Foundation doesn't really control any of this stuff, right? It just happens by itself. But in terms of what I think is the most exciting, it definitely is the financial inclusion element, right? Especially the stories out of Argentina and South America in general, where you have people that actually are able to, they're able to use DeFi and blockchain to really like opt out of their own failing systems, essentially, right? And they can prevent being like having value extracted from them by their governments through things like hyperinflation. And I think that's just, that's something that is really powerful, right? Because especially in the way that what Maker really offers and what DeFi offers is, it's an alternative that isn't just like, new boss, same as the old boss, right? It's not like now they have, so maybe they start using DAI instead, and then the next thing is going to happen is then DAI is going to start hyperinflating or something like that, right? But the thing is that, the entire system is designed to not be able to do this, right? That is just the big difference, that it's transparent, that it's built from the ground up to really have that like extra element of being like a protocol that, that fundamentally exists to serve the regular people rather than the incumbents that control it. And you get that through DeFi, right? You get that through blockchain, because you just don't really build someone who sits there with centralized control into it, right? You build it so that it's controlled by everyone.
So Rune, my last question, what are the ways that traditional finance or traditional banks like us can work with DeFi players like MakerDAO in order to accelerate the growth of DeFi?
So basically, there's so many different ways to use it, right? You can just, and I think the most important thing is to find some sort of use case that makes sense in the short term, right? It's about taking these like small steps that actually, have some sort of real use, right? And I think, so one example that we've looked at in the past with banks and financial institutions is remittance, right? That's like a really good use case for stable coins, basically, and it's pretty straightforward. I think the bigger one that's going to come, that's really going to make a big splash, is the real world assets element, right? Of like being able to collateralize and borrow based on tokenized real world assets, and just get better and more efficient credit because you're able to generate the DAI directly from Maker.
Got it. Yeah, thank you so much, Rune, for joining us today. I hope that we can have you back again to chat with us next time. But really appreciate your time today. Thank you so much. We have too little time to talk. We need like another 1 hour. Thank you so much.
Thanks so much. It was a pleasure.
Thank you. Bye.
Bye-bye.